Welcome to Magic Minutes by MGIC, mortgage industry training that helps you expand your knowledge and skills. Before we get started, take a moment to review our legal disclaimer. MGIC is providing this as general information based on current industry guidelines at the time of this recording. It is always advised that you seek the guidance of your own compliance and regulatory departments.
Hello, and welcome to our series on evaluating and calculating borrowers' income. I'm Sandra Sweeney, Senior Customer Trainer and Program Designer for MGIC. In this introductory module, we will explore how employment and income should be analyzed for stability in order to qualify income. During this presentation, we'll cover 4 topics: how to look at the income section of a loan file to determine risk factors, 3 trios that determine eligibility, documentation, and qualification. Then we'll discuss the difference between fixed and variable income. Lastly, we'll review income documentation requirements. So, let's get started. Keeping in mind that our discussion today will be from a conventional conforming perspective, it's important to know how Fannie Mae and Freddie Mac view income. When assessing income and risk, what do the agencies ask us to take into consideration? Upon review of their selling guides, we note that Fannie Mae indicates that a stable and reliable flow of income is a key consideration in mortgage loan underwriting. Fannie Mae also states that to demonstrate the likelihood that a consistent level of income will continue, lenders must obtain information about prior earnings. Freddie Mac indicates that the analysis, verification, calculation, and determination of the stable monthly income amount is integral to the overall qualification of the borrower and determination of the borrower's capacity to repay the mortgage and other monthly obligations. Both agencies emphasize that in order to predict whether it is reasonable to expect the income to continue, lenders should focus on the borrower's past employment history, as well as the history of receipt of income. They seem to suggest that the best predictor of future behavior is past behavior, and that a stable employment history along with a consistent history of earnings will result in stable income in the future. Stable income can be defined as the borrower's verified gross monthly income from all acceptable and verifiable sources that can reasonably be expected to continue. So in order for income to be eligible, it must have a history, be verifiable, predictable, and this will lead to the likelihood of continuance and stability. Of course, income is only one part of the risk assessment in the overall loan file. Let's take a look at how a file is reviewed as a whole. At MGIC, we break a mortgage file down to the 4 C's: credit, capacity, capital, and collateral. The important thing to remember is we don't look at any one of these sections by itself. We assess the overall risk in the entire file and then make a determination, taking everything into consideration. Is this loan a good risk? In simple language, we are trying to determine how likely is it that the borrower will repay their mortgage. Income would fall under the capacity area, and the stability income is a high indicator as to the borrower's ability to repay in the future. In this section, we'll look at the 3 trios related to income. First, we'll explore further what is required to determine if income is eligible for qualifying purposes. Second, we'll touch on how the source of income can affect documentation requirements. Lastly, we'll look at the steps we take when evaluating income. In most cases, a 2-year history of receiving a consistent level of income is required in order for the income to be considered stable and to use the income for qualifying. So again, we look for history. Have the borrowers had a history of being employed for the last 2 years? If the borrower has had a history of changing job frequently, but are still able to earn steady and predictable income, then that income can be considered to be reliable income. Consistency. Has the borrower's income been stable in the last 2 years? This addresses the borrower's level of earnings. Trends in earnings need to be reviewed in order to determine stability. Continuance. A key driver of successful repayment of a mortgage is the confidence that all of the income used for qualifying will continue for the foreseeable future. Income documentation must be present to support a 3-year continuance. So the likelihood of continuance needs to be determined. The important question that needs to be asked, is the income likely to continue? The left-hand column is income that most likely will continue, whereas the right-hand column is income that will have a defined end date. If you are using income for your borrower from the right-hand column, then documentation of at least a 3-year continuance will need to be obtained and present in the file. The next income trio that we are going to look at are the different sources of income. The different sources of income could be from a primary job, a secondary job, and additional income. You could have one borrower that has income from all 3 of these sources. They could have a primary employment as well as a part-time job and additional passive income such as child support, alimony, or rental income. Income sources need to be considered because income documentation requirements can differ depending on the source. For example, if secondary income is going to be used for qualifying, then the borrower needs to have a history of working a primary job as well as that second job for at least 2 years. The last income trio that we're going to discuss are the steps that we take in order to evaluate income. We call these steps the DCAs of capacity. First, we're going to document the income according to the source and the type. Second, we're going to calculate the qualifying income by taking into account any trending rules that we need to consider. Last, we'll make an analysis of the stability of the income to determine whether or not the income is eligible for use. As you might imagine, that last step is a very important step in the origination and approval process. Now let's talk about how not all income is the same. Not all income is evaluated in the same way. Some income is not as predictable as other income and is therefore considered riskier. Income is typically broken down into fixed income and variable income. Let's look at how these 2 different types of incomes are defined. First, we have fixed income. This type of income is income with a predetermined amount that occurs with a regular frequency and has a defined documentable term. The trend of this income should be steadily increasing. Fixed income is generally based on an annual salary and is received in a predetermined amount, either weekly, biweekly, semi-monthly, monthly, or even hourly. If it is received hourly, the borrower's pay stub should reflect the same hours per pay period. Variable income is different from fixed income in that the amount is not predetermined, does not occur with a regular frequency, and a definite amount is not documentable. The income trend for variable income is not predictable and most likely will reflect fluctuating earnings. Some examples of variable income are hourly with no set hours per week, secondary or part-time employment, overtime, bonus, commission, shift or on-call differential. In the next section, we'll discuss income documentation requirements. These days, we have many more options when it comes to documenting income. We can obtain documentation directly from the borrower, from the employer, or even from third-party sources. Regardless of the source, the lender is ultimately responsible for the integrity of the documentation. It doesn't matter what your role is within the mortgage industry. You should become proficient in the review of income documentation and be able to determine if all documentation requirements have been met, such as, is the verification complete? Are there any discrepancies between the income documentation and other documentation present in the loan file? Are there any red flags evident upon review? Are there any questions that need to be asked? Does any supporting documentation need to be obtained? Let's look at some basic documentation requirements, starting with documentation that will be obtained directly from the borrower or from the employer. This documentation will generally be in the form of pay stubs, W-2s, or a verification of employment. Documentation should be dated no more than 30 days prior to the date of loan application and should be no older than 120 days at note date. The number of pay stubs should be sufficient to determine pay frequency. The number of W-2s will be dependent on the underwriting path. Is this a manual underwrite? If so, year-to-date income documentation along with the past 2 years of earnings will need to be obtained, along with a verbal verification of employment dated within 10 business days of the note date. There are some alternative ways of obtaining income verification. Documentation can be obtained directly from third-party vendors, such as the work number. Verification of income can also be obtained through AUS systems, such as Desktop Underwriters Day One Certainty or Loan Product Advisors AIM. Documentation relief may also be offered through those same AUS systems. It should be noted that certain types of income will require verification through tax returns. What are some examples? The income sources listed here are examples of some of the types of income that require federal income tax returns. We can't rely on third-party verification if that party is related to the borrower or is an interested party to the transaction. Therefore, a borrower that is employed by a family business or by a party that is involved in the transaction will need to provide tax returns. How will you know if a borrower is employed by family or an interested party or has an interest in a business? The loan application should give us a clue. Here you can see a copy of the loan application where we are looking at one of the employment sections. There are two areas that I will highlight. The first area is check if this statement applies. I'm employed by a family member, property seller, real estate agent, or other party to the transaction. The second area is the self-employment indicator, where your borrower will check if they are a business owner or self-employed. And of course, if per Fannie Mae and Freddie Mac, they have an ownership interest of 25% or more, then they are considered to be self-employed. Questions to ask. Do the borrowers have a stable employment history? Does the history of earnings verify that the earnings have been level and consistent? Take a moment to check your understanding. Do you know how these two statements should be completed? Let's go over these statements together. Income is generally considered stable if received for the past 2 years and likely to continue for an additional 3 years. Income verification should be dated within 30 days of loan application and should not be older than 120 days at time of note date. Remember, qualifying income must be reasonable, verifiable, consistent, stable, and likely to continue.
Thank you for joining us for Magic Minutes. We hope this brief tutorial has made a difference for you. For more how-to videos, visit mgic.com/training.